navigating the multi-state tax maze, Nexus, apportionment, and the remote work revolution. Do you own a multi-state business, an e-commerce company, or employ remote workers? Then you've probably found yourself wondering or even stressing about the implications of multi-state taxation. After all, you may actually owe money in different states without even realizing it. Well, that's one concern we'll help you cross off your list. In this video, we'll walk you through absolutely everything you need to know about the increasingly complex interplay of multi-state taxes with modern business operations. That's a mouthful. Not only will this give you some clarity and insight, but it may also save you money in the long run and help you come up with a winning tax strategy. So get ready to have all of your questions answered, including those you didn't know you had. To start, let's clarify two key terms you've probably heard surrounding this topic. The first is Nexus. If your business has Nexus in a specific state, you likely owe that state taxes. Now that's all fine and good, but what exactly is Nexus? It means that the local taxman can rightfully tell you, you're doing enough business in the state and now you owe us taxes too. Once you have Nexus, you're on the hook for state taxes and most usually for sales or income taxes. This can be because of where your business is located, including staff or stock, or whether you generate sales there or even have sales reps or affiliates in that state. So imagine you have a small online business selling homemade candles in your home in California. At first, you only sell to people in California. Easy, you only deal with California's taxes. But then, your candles get popular and you start shipping a lot to Texas. Once you hit Texas's sales threshold, you create economic nexus in that state. That means you now have to register, collect, and pay Texas sales tax on those orders. Later, you hire a marketing assistant who works remotely from New York. Boom, now you have physical nexus in New York because you have an employee there. New York can also require you to follow its own tax rules. So even though your business is based in California, as you grow and connect with other states through sales, people, or property, you create nexus in each of those states. And then there's apportionment. This is how states divide up your business income so you're only taxed on the part connected to them. Oh, and before we get into this, be sure to check out our free multi-state tax guide. I've added the link in the description. Imagine you run a business that makes money in several states. Each of those states say, hey, since part of your business happens here, we deserve part of your tax bill. But you can't pay full taxes to every state, as that would be double or triple taxation. Instead, the law uses apportionment to slice up your total income into fair shares for each state. So how do they slice it? States usually look at three main factors: your sales revenue, how much you pay your employees, or whether you have property like warehouses or equipment. Now, the difficulty here is that not all states weigh these slices equally. However, sales are usually the most important factor. Let's break it down through a practical example. Say your company makes $10 million total, with 50% of your sales in California, 30% in Texas, and 20% in New York. If California uses only sales to apportion, then 50% of your $10 million or $5 million gets taxed in California. Texas gets $3 million worth, and New York gets $2 million. Each state taxes their slice. And only now can we get into the nitty-gritty details of multi-state taxation. Are you ready? Hold on tight, here we go. Nexus is the foundation of multi-state taxation. Nexus is the legal connection between your business and a state that gives the state authority to impose tax obligations. Now that we've hinted the above, there are quite a few different ways this can happen. A physical presence nexus is triggered by having tangible assets like offices, warehouses, or employees in a state. However, if you sell online, this includes more than just your own company's presence. The inventory you may have via third-party fulfillment centers like Amazon or Etsy marketplaces also counts. Economic nexus doesn't have anything to do with where your company is located. It is established where you sell enough stock to make enough transactions to exceed a state-specific thresholds. These can vary depending on where you conduct business. For example, in New York, this means $500,000 in gross sales and 100 transactions. And let's be realistic. Listing the thresholds for every state in the country would keep us here forever. So if you need more details about the thresholds of other states, check out our blog in the description. Moving on to affiliate nexus. This is seriously important if your business has any relationship with in-state affiliates or third parties that promote sales for you. So think about influencers that give out promo codes to their followers across the US. Having someone in your family or friend circle sell their stock through your company, despite being halfway across the country or sharing resources with a different business. Finally, there's payroll of employee nexus. This is crucial for companies that have remote or hybrid staff. If your business employs just a single remote employee from a different state, it can trigger nexus and tax obligations. So let's dive into how and why. The impact of remote workers on your Nexus and taxes. Having remote and hybrid employees instantly creates a tax present in the state your staff live in, which means you need to start thinking about things like corporate income tax, sales tax, and payroll taxes. Firstly, this can present complications around withholding taxes. When your company pays employees, it has to withhold or set aside and send in income taxes to the government. The tricky part is that the state taxes depends on where the employee both lives and works. And with remote staff, those are usually not the same place. So why is it complicated? Basically, every state makes its own tax laws. Some have income tax, others don't. Some have agreements with the neighboring states, others don't. This means that your company can't just follow one blanket rule. So if your staff live and work in the same state, that's easy. You'll withhold that for the state. But if they live in one state and work in another, either remotely or by traveling, you might need to withhold for both states, depending on the rules. In short, withholding is about making sure that the right states get their share of income tax, based on sometimes a messy mix of where your employees live and where they work, and how the state laws interact. But some jurisdictions do try and help you with this through convenience rules and reciprocity agreements. Convenience rules apply in states like New York, Pennsylvania, Massachusetts, Connecticut, Delaware, and Nebraska. Here, you can tax employees as if they were working in the business's home state if their remote location is for convenience, not necessity. Reciprocity agreements, on the other hand, simplifies withholding by letting your employees pay income taxes only to their state of residence, even if they work in a different state. If you need more information or facts about the implications of remote work on Nexus and taxes, or want to read more about withholding and what it means for your business, check out our blog in the description. Okay, are you ready for even more information? Let's dive into apportionment. Decoding apportionment, how your states divide your income. So as we explained at the start of this video, apportionment is the method the states use to divide your company's total income so that they know what portion is taxable in the specific state. The main reason for this is to help your business being taxed twice or even multiple times on the same income. And don't forget, this is also discussed in our multi-state tax guide linked in the description. There are different ways to do this. One is what's called the cost of performance, or COP. Yeah, your income from the services is taxed by the state where the work or the cost of doing the service actually happens, not where your customer is. So say you run a digital marketing agency in Florida, but your client is in California. Since Florida allows COP, your revenue is considered earned in Florida because that's where you and your staff did the work. California doesn't get to tax you on the income, even though your client is based there. Then there's market-based sourcing. Here, instead of looking at where the work is done, your state looks at where your customer is located and where they receive the benefits. That means that if your marketing agency is in Georgia, a market-based sourcing state, with a client in California, Georgia says, nope, that revenue belongs to California because that's where the customer benefits. So your income from that project gets sourced to California, not Georgia. But how do states decide how to divvy up your income? Essentially, they need a formula to figure out how much of your total income they can tax. This can be a single sales factor in which the state only looks at the sales revenue made in that state, or a three-factor formula based on your sales, property, and payroll. In this case, if you make 10% of your sales in state A, with 20% of your employees' payroll in that state, and 30% of your property there, the average is 10% plus 20% plus 30% divided by 3 for the 3 factors, giving you a grand total of 20% tax on your income. If you're still unsure about apportionment methods and need more examples, don't panic, we have another video explaining it. And now that you know the different aspects that are taken into consideration with multi-state taxes, we can move on to how this knowledge can help you create a tax strategy to save your business some of its hard-earned cash. We're here to remind you that no matter how complicated multi-state taxes may seem at first glance, there's light at the end of the tunnel. With a little knowledge and some preparation, you won't need to lose any sleep about your taxes or have your accountant breathing down your neck. Here's what to do. Start with proactive planning. You need to regularly assess your Nexus exposure for all your business activities, including remote workers and sales thresholds. Remember that this isn't something you can do once and then forget about. Tax regulations are always changing, and as your business grows and changes, you may need to adjust your strategy. You'll also need accurate records. Your documentation for sales, payroll, and expenses and apportionment calculations need to be correct, easy to locate, and kept to support your claims to ensure you won't get caught out by audits. The easiest way to do this is to use the right tech and to reach out when you're in doubt. Accounting software can help you with everything from automating tax compliance and streamlining your filing, but it's only as good as its users. By partnering with tax pros, you can ensure that your strategy and your actual tax filings work for you. And that's where we come in. Fusion CPA has a team of tax and accounting experts with years of experience in multi-state taxes for different business entities in a number of industries. We'll be able to help you plan, prepare, and submit your taxes without worrying about delays, issues, or inconsistencies. So what are you waiting for? Schedule a free discovery call with us today and let us handle your multi-state taxes worries for you. And remember, multi-state taxes are tricky, and we've simplified it for you. We've linked our free guide below. We've put together a free family business guide covering tax basics, accounting best practices, and practical tips you can use right away. Grab your copy below.